Why is Germany's economy doing so badly now? Their economy has been having trouble for over a year by now. They've narrowly avoided a recession last quarter, but year-over-year growth is still really slow at 0.5%. What exactly has been happening with the European economy? For so long before this, Germany has been looking down at other parts of Europe, saying how superior their economic management is. Germany has been wagging its finger at other European economies for so long, saying that they've run their economies badly, and they should run their economies more responsibly like Germany, and now Germany's economy is the one that's failing. All of that time, the only reason the German economy has been doing any better than the French or Italian economies has been because of its exports. Unlike other European countries, Germany's economy has not been running under its own power. It's been using technological monopolies to suck resources from the rest of the world and draw income into it. Exports are 45% of Germany's economy, so Germany's economic success is completely dependent on other countries. When other economies slow down or otherwise reduce their demand for imports, Germany's economy is going to be hammered, which is exactly what's happening. Without its export, Germany is Italy with more punctual trains. What's immediately precipitating this is a slowdown in China's economy. However, even if China's economy wasn't slowing down, China's economy is already industrialized, so it's moving to a less capital-intensive phase of growth, and demand for German capital goods imports would be declining anyway. Also, China is moving up the value chain, so it's going to be producing the same goods that Germany exports soon, much more cheaply due to its lower labor costs, and outcompete it. Even if China were growing as fast as ever, its demand for German imports would still be declining, and Germany would still wind up in this situation. So I have this article up talking about Germany's economy from Reuters. Germany's economic pain is here to stay. It was meant to be a fleeting slowdown for Europe's economic powerhouse, followed by a rapid rebound. Instead, Germany has been stuck in neutral for a year, with hopes fading for a turnaround, a situation that threatens to spread lasting economic gloom across Europe. Yes, Germany is very central to the economy of Europe, and because it interacts so closely with the other European economies, it could very easily negatively impact them along with it. Its vast industry is in recession, a victim of shifting consumer trends, China's economic rebalancing, and a global trade war. Investment spending is shrinking, sentiment is souring, job creation has stalled, and productivity growth looks to have turned negative. Compounding the pain, what was thought to be an unfortunate coincidence of one-off factors has turned out to denote deeper structural problems that will keep Germany, and by extension a 19-member Eurozone, weak well into the next decade. Well, this doesn't sound good. Exhibit A will be Thursday's release of third quarter growth data. The German economy grew 0.1% that quarter, which is expected to confirm fears that Germany is in recession. Whether the actual figure is minus 0.1%, as a Reuters poll indicates, or merely shows a flat outcome, does not change the bigger picture. Germany is likely to remain in a zone between modest positive growth and slight GDP declines. Commerzbank economist Jörg Kramer said, "Once the downturn is over, however, there is unlikely to be a strong economic recovery. The German export industry will suffer for a long time to come." That will be due to the reasons I just talked about before. Structural flaws. Germany's Independent Council of Economic Experts delivered a similar grim message just days ago. The good old days are over, and it's time to reform. Germany is slow to adopt new technology, investment is weak, and barriers to starting new businesses are too high, said the five-person council, whose members include Isabel Schnabel, soon to be a member of the European Central Bank's Executive Board. I hope I didn't mispronounce that too badly. I probably did. Its rapidly aging population helps keep productivity growth weak, because the labor market is shrinking, and skilled workers are hard to come by. Firms hoard labor even during downturns for fear they will struggle to hire during the rebound. Banks are of little help to the economy either. They operate with the highest cost in the Eurozone, and their combined return on equity is the second quarter was 0. This is a problem because banks restrict lending when the economy slows to save capital, exacerbating any recession, and with earnings already weak, they are unlikely to support the economy. Banks' low profitability poses risk to financial stability because it hampers the buildup of equity and provides incentives to take excessive risk, the council said. Stimulus would appear timely given this environment, but little more is likely to come. The ECB has already done almost all it could to lower its borrowing costs, which are now below 0, I think. Indeed, the Bundesbank estimates the German state saved 368 billion euros in borrowing costs in the 10 years to the start of this year. The government could use those savings to boost spending, as it has one of the lowest debt levels in Europe. But in a country obsessed with running a balanced budget, meaningful fiscal stimulus is politically unacceptable. Well, German frugality bearing its fruits. Berlin has long resisted calls for a big spending boost, arguing that an aging population requires savings, and that firepower must be preserved for a real crisis. So what exactly is a real crisis going to happen? A surge in infrastructure investment would be problematic anyway, as the construction sector is running at capacity, so it would struggle to absorb the extra cash. Such a grim outlook does not automatically translate into economic gloom for others, and data on Friday showing German exports posted their biggest rise in almost 2 years in September offers a glimmer of light. But Germany is the top trading partner for most EU countries, with value chains reaching well beyond borders. Yes, I've read articles and made videos talking exactly about how central Germany is to the rest of Europe. So we'll see what the knock-on effect is in the future. Indeed, when the European Commission slashed its 2020 growth forecast for Germany earlier this week, it also cut its projections for most EU countries. As the Commission put it, the bloc is at a crossroads. It could enter recession, muddle through with a protracted period of low growth, or find a way to rebound, seen now as the least likely outcome. The eventual direction depends very much on Germany. Okay, so I got confused and thought this was part of the article when it's actually an entirely new article. So anyway, that's the end of the video. Please like, subscribe to my channel, leave your thoughts in the comments, hit the notification bell, and share this video with anyone else you can think of. That's it. Great.